on the draw there.
Good work, Joe. Let's be
Good
honest.
work.
Good work.
Good work. All right, let's bring in today's guest analyst, Ben Rand, Blue Line Futures. Ben, welcome to AgriTalk. How are you, man?
Oh, I'm good, Chip. How are you?
Doing real fine, real fine. First time on, we need to learn about you. Let's start with where you're located, what your interests are, and what your office offers for services out there.
Well, I am originally a farm kid from southeast Nebraska. Grew up on row crop, your typical corn and bean guy. Dad and I ran over a few acres and worked as a hired hand through high school. Went to college in Omaha to become a pilot, and then September 11th happened, and did a little bit of a demand destruction, if you will, on the pilot career path. So
Yeah.
I really had to relook at what I was going to do. Ended up joining the military, and I think this is where a lot of people kind of wonder how I landed in Elwood, Nebraska. But no, I joined the military and became a cryptologist. I was a code breaker. They sent me to school to learn Persian Farsi. From there, the Department of Defense kind of rearranged how they were viewing intelligence assets and made me an interrogator of all things. Did a couple deployments, came back, learned Arabic, did a Dari conversion course. So I speak a few languages, been to a few countries. Back in 2014, kind of came down on an assignment that I wasn't super enthused about having to go do. I'd been gone almost, my kids were 6. I had like 28 days stateside, and it was just time to spend some time with the family. So I decided to get out of the military, came back to the family multi-peril crop insurance company, got hired by one of the big 4 grain buyers as a broker, did several years there, and then have ended back in the risk management side of things with crop insurance, LRP. I don't know, it was a couple months ago. Excuse me, a couple months ago, Oliver reached out and knew what I was doing with LRP, LGM, saw what I was doing on Twitter, and we had some common contacts. And we decided it would be a good fit to join, for me to join the Blue Line Futures team.
Gotcha.
And we'll talk a little bit about leveraging either LRP and a hedge account or both, and how these tools can work to help, really transfer some risk for the cattlemen in what is arguably a high stakes poker game here with some of these numbers we're looking at. But that's how I ended up. I sit and live in Elwood, Nebraska. But I'm licensed for insurance, like anywhere between Colorado and Ohio and North Dakota to Texas. Got clients scattered all over the place. Cattle aren't limited to Nebraska and the Midwest. So really have a big, big territory I cover.
Yeah.
But that's my backstory. Blue Line really offers the futures and options side of things, which I know some folks are scared of or don't have the knowledge or have been burned and don't want to get involved in it. And then on the home agency side of things, we offer the LRP, which it's a fixed cost program. You know what you're getting into. There's no margin calls. Premium's not due to the end. And it just fits a small time family feeding operation quite a bit better than, say, a hedge account.
Gotcha. Ben, the experience that you've had with the military, I mean, that is a big round trip to end up back at Elwood, Nebraska. How has that shaped what you're doing now? How do you use that experience in what you're doing now?
So I spent most of my time in special missions units and special missions assignments. Almost all my time was in a special missions assignment, just due to the nature of what I did and my qualifications. And to be real honest, it's a lot of data consumption. If you're going to put U.S. soldiers out on a target, you're putting somebody's livelihood, somebody's dad, brother, son in harm's way. You better be sure about what you're doing, and you got to make fast decisions. And we're looking at these gray markets over the last 2 years. The correlations are really uncanny. Things have exploded up, exploded down, collapsed, come back, moved all over the place. And to be able to assimilate that data, both on the technical and the fundamental side, I think is something I really try to help some of these smaller time family feeding operations across the Midwest understand, and then leverage these products to, transfer some risk, take some risk off the table, and be a better marketer.
Gotcha. So this is all shaped a risk management philosophy for you. How do you sum up what your goals are when you sit down with somebody and figure out what risk management strategy is best for them?
Well, when I was in the military, one of the things we've always had was we had a 3-to-1 rule. We just weren't going to go on target if we were out,
Yeah.
if we didn't outnumber them 3-to-1. And then when I'm sitting down with somebody, everybody's risk tolerance is different, right? But I don't ever want somebody to take a position or make a sale or something where they're not 3-to-1 in the good. And that's just something that's kind of transferred. I think, I'm not going to risk a dime to capture or risk 30 cents to capture a dime. I want to be on the right side of those trades, make educated decisions that's data driven, both with historic, fundamental, technical analysis. And that's what I want farmers to understand, and producers, ranchers to understand that this is a program that is super easy to access. And once you find somebody that's the right fit, maybe it's not the right fit for everybody. It's not. I mean, there are limitations to it. It won't work for everybody, but it is a tool. And if you have a hedge account or are looking to utilize a hedge account, Blue Line offers that on the other end of this equation too. Two tools in a toolbox. And that's my take on it. Really, is I like those 3-to-1 odds. I want to put somebody on the winning side of their positions.
Nice. I love it. Okay. You know what? One more on your, what kind of drives you.
No, go ahead.
And how you make decisions. Fundamental, technical. I heard you mention them both. Do you follow the fundamentals and then use technicals for timing, or how do you combine the two?
Okay. Well, we'll talk specifically about LRP because I know that's what a lot of people have wanted to hear about. So on the LRP, it's a huge technically driven market because the premium, what we're going to charge for the LRP coverage, is going to be driven by the value of the put. Well, the value of the put with the corresponding strike to the futures month, that value of that put is not going to accelerate fast in a bull market. So the timing is absolutely everything. You want to book this LRP on a day where you actually a series of days where you can string together several green candles. The put has not gone up incredible, any sort of incredible value, but the futures month has. And that is where you're going to have the technical side of this comes into play, is knowing upfront, hey, I'm trying to string together several green days, and then I'm going to pull the trigger on this. So that's on the technical side. The fundamental side, I mean, we have to look at the cot. We have to look at stuff. I drive across Nebraska on the daily. I mean, I'll cover 4 states in a day to go visit clients. And the fundamentals are the Western Corn Belt's burned up. The pasture's in terrible shape. You talk to anybody out here, there was very little heifer retention coming into this year, and they're starting to look at it now. There's some optimism starting to grow, right, with the snow that's melting. And you're starting to see pasture get wet. I got mud on my truck for the first time in Western Nebraska. I've been out here 2 years, and I got mud on my truck for the first time 2 weeks ago. So, you've got this, I guess, for lack of better terms, just optimism. And you combine that with the cot, and you look at, box B. I mean, there's a bunch of stuff to layer in here. And that's where Blue Line really helps, me make some of these decisions when I'm helping folks with the LRP. It's a fundamental, technically driven market. You got to use both of them. You can't be lopsided on one or the other.
Yep. Okay. You used a phrase that I haven't heard on the show before. All right. We've only been doing this close to 9 years, and you said string several green candles together. You're talking about a candlestick chart, but what exactly does that mean? I mean, it's momentum is working to the upside.
Yeah. So on my charts, and I'm sorry if you hear me clicking here, but I'm literally looking at my charts in my office, which is so strange. What insurance guy has, cattle charts going every day? But this is so important when it comes to LRP. So if we're looking like a 1 month, 4-hour chart or 1 month, 1 hour chart, we have a chart pattern called a candle that we use. And when I say the term string together several green days or several green candles, what I'm trying to see here is I want to see several days where the market has consistently traded to the upside and has consistently added, price structure positive, and that the corresponding put has not increased in value very much. And that's what I mean by that. We want to see several days in an upward market. Where LRP does not work is when you string several red candles together and you got the market setting back. People are buying the put. The skew is to the downside. So the put is increasing in value. And that is what you want to avoid.
Gotcha. Okay. we're off and running, and we're off and running strong with Ben Rand, Blue Line Futures. So, that final decision-making process on whether or not an LRP works for you. We've strung those green candles together. We're going to go through that final decision-making and what kind of protection it gives you. We've got Ben Rand, Blue Line Futures on AgriTalk. Guest analyst today. We're talking about LRP. So, Ben, when you initiate an LRP strategy, what is protected? What protection does it provide?
Great question, Chip. It is probably, in fact, I do a lot of insurance products. It is the only insurance product that I'm aware of that you can buy that settles against a cash index. For feeders, it settles against the CME cash feeder index, and for fats, it settles against the 5-area weighted average for the 35 to 65% animal. So really unique in the sense that we are setting a position against a Chicago Board of Trade month. I'll give you a great example. Let's take a look, like in August, I was looking at some 8 weights for a guy earlier today, and he's going to have some 8 weights, 8.5s are going to be ready to go feeders in August. And he could, as of last night, book those cattle for 207 would be his coverage level and change. And it was going to cost him about $4.75 a hundredweight to do that. So on a 8-weight steer, you're going to spend $37 and you're going to lock up a coverage level of 207. When we go over and we look at the CME cash feeder index, that closed yesterday at 181. For example, had he had this contract on and it would have expired yesterday and he had a coverage level of 207 and we closed the cash feeder index at 181, we would have owed him $26 per hundredweight on that, regardless of what he sold them for at his sale barn. It has nothing to do with what that producer does with that animal at the sale barn or into a packer. Okay. It has everything to do with the indexes. And I actually put this out. I don't know if you saw it, Chip. I put it on my Twitter account because I was going to reference a couple places. All this stuff is completely available to the public. None of this is like secret hidden magic. I don't know what the margin calls. It's just not. And I think that's really the neat thing is because if you don't want to talk to me or your guy about LRP, you can look it up on your own. Yep. And the links are on my Twitter account. You're more than welcome to go look at them, click on them, and pick away and shoot me a DM. I'll explain to you how it works. But you're locking up a cash coverage level is what you're locking up. And there isn't a single other commodity. Imagine if you could lock up 597 corn, cash corn, and spend it government subsidized, but you can't do it. So no, it's a neat program and it settles against the cash market.
Okay. So it pays off if the market goes down, but it also pays off if the market goes up because you still got your cash to sell, right?
Yeah, well, I mean, let's say same scenario we're talking about those August feeders at an 8.5 weight feeder. Same scenario, you lock up 207. If at the end that particular contract I think expired August 7th, if I remember right. At the end, let's say the cash feeder index is 220, and he takes them to the Ford or Bassett or one of those hot sale barns that you see crazy numbers coming out of, and he gets 230 for it. All he's going to do is owe me the premium. That's the really nice part about this. The premium is not due until the end. That was a change back in 2020. Yeah, big change in 2020 was the premium's not due to the end. So he takes those animals, sells them at the sale barn. He has unlimited upside in the cash. All he's doing is setting a cash floor.
Gotcha. Okay. So LRP is available fed cattle, feeder cattle, and hogs, right?
Yes, sir.
Okay. Now, there's another one that you mentioned that I feel like we at least need to mention, and that's the LGM, the livestock gross margin.
Yep. So livestock gross margin is the cattle crush, for those familiar with that term. Okay. Most family-owned feeders will call it their break-even. Like we buy the feeder, we buy the corn, we sell the fat. That's the cattle crush. They're going to have more stuff built in like trucking and yardage and a few other things. But when we're talking about it from a brokerage or hedging perspective, we call that the crush. LGM does exactly that. The problem that we have right now with LGM was one that we had with LRP up until last year. On LGM, and you won't hear me talk about it a lot, but on LGM, the reality is you can only go up to a 1,250 pound fat animal. And
Oh,
there are, yeah, I mean, you got guys shipping
yeah.
700 weight fats, and they're just leaving too many pounds on the table. We're working diligently with a couple of our carriers that I write for to get that change this year. I'm excited and hopeful that, come 1 July, we will see a fundamental change and raise that from 1,250 to 1,600. But right now, I just feel like it leaves too many pounds uninsured, and you can buy up to 1,600 on the LRP. So, go that route with it, and you get all
Gotcha.
1,600 pounds
Gotcha.
insured.
Okay. All right. Interesting. Gotcha. Okay. Um, let's talk a little bit about the fundamentals in the market right now. This cash market responded last week. Feels like the support from the supply side of the market is there. Is the demand side of the market the uncertainty?
Oh, not just the demand side, but the economic side. That really
Yeah.
trickles down the secondary, tertiary effects to the American consumer. You got, you know, I've always I've always said recessions catch you off guard, and you go on any social media platform and everybody's talking about the pending recession. I don't know if it's coming or not. The charts don't look good on any equity, or I mean, it makes you really nervous about where we're headed with credit card debt and all-time savings accounts being low, and just some of the alarming statistics from the financial sector that you're seeing. I guess for me, the demand side is a big question mark, huge question mark. Is the American consumer going to be able to afford the beef coming off of you're going to have people that talk about a 180 fat, a $2 fat. Um, can the American consumer support that environment? Huge unknown, and it has a lot to do with where the economy is going to go.
Yeah. It certainly does, and we've got there. It seems like there's a lot of movement going on out there right now. I've got one more thing that I want to come back to on the LRP, but
Sure.
first, I feel like we need to get your expectations for tomorrow's supply and demand report. Any what any expectations at all for the February S and P?
Oliver and I talked about it this morning, right? So, 2020 through 2022 has taught us that logic means nothing and be expected expect a surprise. So historically, February, pretty docile. Call it a snoozer, call it a dud, call it whatever you will.
Yeah,
But that is not a suitable reason to not have protection on going into one of these things. I never advocate somebody to trade a report because you just never know what's going to get
right.
printed. Volatility, gosh, we just have seen some incredible opportunities in the market. My logic tells me to expect my dud. My tingly senses tell me like be on guard.
Yeah,
But historically speaking, February is not a super big market mover, and we're talked about it earlier. You could expect a little bit of an Argentinian reduction.
yeah,
How much we don't know. Brazil's obviously got a monster crop, depending on who you listen to and talk to. Um, Corn, moderate increases to some expectations, or not even moderate, very small expectations to
yeah.
carry out. So I would say, if I'm going to, have to be hold a gun to my head and pick a side, I'm going to say this thing's going to be a snoozer. That is
Okay.
historically what it's given us. Yeah.
Okay. All right. Very good. So, as you were describing the LRP, I'm sitting here trying to figure out, okay, is this for a big guy? Is this for a small guy? Who is who can make the best use of the LRP?
The folks that I talk to that you make the best use of it are typically your 5,000 head and smaller feedlots.
Okay.
I have a kid in Nebraska, wonderful kid. He books 3 head with me a year, three, and his three head are just important to him as the 3,000 of the guy up the road. And that is
Right.
one of the nicest things about this product is that you can do as little as 1 head. You don't have to buy or sell a whole contract like you do on the Chicago Board of Trade. You can
Amazing.
1 head, 10 head, 18 head. Let's say you have a pen of, I'm working with a guy in Iowa. He's got a pen of 100. He's like, let's break it up into 3 chunks, and we'll put 33 on here, 33 on there, 34 on there.
Okay.
And make a calculated approach. Each person's different. Everybody's got a different expectation of risk management. But Who's this geared to? There are limitations. You cannot do more than 12,000 head in a day or 25,000 head in a year. So that automatically knocks out some of the bigger feedlots. It's just not for them. It's for the American. Right. It's for the American family-owned operation.
Okay, boy, this seems like something that a lot of farmer feeders need to get to know and talk to somebody like Ben. And I'm not saying that it's got to be Ben, but Ben is obviously a pretty good choice if you want to get started with it. Figure out exactly how it can work for you and your operation. And Ben, it's been a pleasure to get to know you. You're in the rotation now, man. We'll get you back on again soon, okay?
Let's do it. I appreciate it. All right.
You bet. That is Ben Rand from Blue Line Futures out in Nebraska. Now, when we come back, going back to Blue Line Futures, we'll get Oliver Sloup in here to talk about the weekly options. That's next here on AgriTalk. Welcome back to AgriTalk. I'm Chip. Glad that you are with us this afternoon. Really good conversation with Ben Rand there from Blue Line Futures. Davis found us a new go-to for some of the risk management tools that are available to us out there that growers and livestock producers in particular need to be taking a look at. No question about it. Okay, Oliver Sloup is with us every Thursday. It's not Thursday, I realize that, but here it is Tuesday afternoon. And as we were talking about getting Ben on here, I said something to Oliver, we need to get you on sometime and talk about the new weekly options that are available. And he says, I'm available today. So here we are. We're doing it right now. Oliver, welcome, buddy. How are you, man?
Good to talk to you. It does feel a little weird with it not being Thursday and Tuesday, but I guess they both start with a T, so we're kind of in the realm of things. So
we're okay. We'll manage through it, I'm sure. So, okay, so the new weekly options, what are they? Why?
All right, so the new crop weekly options were rolled out by the CME group on January 23rd. If you're not familiar with options, this may come across as a little bit foreign to you, but typically you have these, options that expire on a monthly basis for old crop contracts, and there were some short-dated options for new crop December and November corn and beans, but nothing with a shorter amount of time. And with some of these big reports coming up, especially the planting intentions report at the end of March, I think that's where new crop weekly options is really going to start to become a bigger player. Obviously, we've got a USDA WASDE report tomorrow, but that's probably not going to have a huge impact on these new crop prices. But that's part of the reason CME wanted to start to roll this out ahead of time. There's not a lot of volume or open interest traded just yet, but they wanted to work out the kinks, get the slow burn. So when we do get to that planting intentions report at the end of March, all things are ironed out and ready to go. And it just so happens that that report is on a Friday, and there'll be new crop weekly options that expire that Friday as well. So if you wanted to take protection or speculate on new crop prices for corn or soybeans on that day, you could do it and not have to pay all that time premium, right? A lot of people look at, how do I hedge the new crop corn, new crop beans? The options are so expensive, and they've got 290 days left on them. I just need to get through this USDA report or whatever other high impact event it is. And that's really where these come into play. And I think are going to be awesome going forward, especially once we get into the weather markets and things of that nature here in the spring and summer.
Yep. Just so that everybody's clear on this, okay, when you look at the premium on an option, it is determined by the intrinsic value. In other words, how close is the strike price to the futures price, the volatility that's in the market, and the time that you pay. Like you said, 290 days until the new crop options expires. You're going to pay more for that than if they expire at the end of the week. This is Oliver, I'm not sure if this is a way to manage the time cost or to manage the volatility cost more effectively. How do you look at it?
I think right now it's a way to manage both. It's a way to give yourself some short-term insurance. Right now, volatility is still seasonally low. If you look back over the last 5 years, we've seen volatility measured by the CME vol index, bottom out in February, rise into the spring and summer, and then recede into the winter months, which, as you can guess, is pretty par for the course, right? We were trying to figure out how many acres and which crop farmers are going to produce. And then you've got the wild card of Mother Nature coming into play, and that boosts the uncertainty, which plays into volatility. And I think that's where these options come into play. Like I said, that planning intentions report on a Friday, just a couple hours to have some protection, I think it gives people a lot of peace of mind, certainly.
Yeah, I can certainly see farmers using it and producers using it in front of those major reports. It seems to me like it might be of interest to traders too. I mean, speculators, managed money.
Yeah.
100%.
It's whether you're an end user trying to protect the upside, or you're a producer protecting the downside, or speculating in the market, wanting to take a stab at a directional play. It's a great way to get that exposure, especially once that volatility does start to pick up, because you're not paying the margin to hold a full contract or however many contracts you want. You're paying premium, assuming you're long the options, which is limited risk. And so you get that skin in the game, so to speak, ahead of these high impact events or a long weekend like we've seen in the past over July 4th, where we start gapping up or down on Sunday night. And I think it's that peace of mind that's really going to make it worth it for a lot of guys.
Yeah. The markets have got to have somebody on the buy side and the sell side. Who's on the sell side of these?
Right. Well, right now it's the market makers, and as Ed mentioned, the volume and the open interest right now is very low. It hasn't traded much. I'm looking at the ones that expire this Friday. I think the open interest at the $6 strike is only 39, and there was I think a penny wide bid offer today, pretty much all day long. So it's still getting ironed out. But like I said, CME released these early on purpose so that we could get more market participants involved and get the kinks ironed out before that March planning intentions report here. I mean, it'll be here before we know it. But to give you an example, that call option, $6 call option that expires in 3 days, I think the last trade on it was about a penny and a half. So if you're a speculator end user looking to protect the upside above $6 on that new crop contract, get you through this USDA report tomorrow, you're only paying 1.5 cents to do that. So it's not a bad deal.
So there's a use for this for everybody in the market, because you just gave me a good use for a livestock producer to use these things too, to protect against some, if something scary would happen and we get a big move to the upside on their feed costs. So we need to talk more about them. Okay, Oliver, let's keep the conversation going. Okay, buddy?
You got it, Chip. Thanks for having me.
All right, man. That's Oliver Sloup, Blue Line Futures. Yeah, kind of a day featuring Blue Line. No question about that. Oliver's been with us for a long time on Thursdays. We certainly appreciate him. All right, come back tomorrow morning. We've got Jim Mintert from Purdue University right here on AgriTalk.